Hello everyone. My name is Anjani Kumar Khetan and I am based out of Bangalore. In this particular video, we will look at another interesting topic, which is the accounting and financial reporting implications arising out of BEPS Pillar Two rules, which have been rolled out by OECD. So we will see how these BEPS Pillar Two rules impact the accounting and financial reporting. So before we delve into the financial reporting and related disclosure requirements, let us quickly recap our discussion on what are the key requirements under the BEPS Pillar 2, because that will set the platform to better understand the financial reporting requirements under, let us say, IAS 12, which deals with income taxes. Now, this is something which we have discussed in one of the earlier videos, and I will actually in the description also give a link of the previous video. But if you recollect, what we have kind of discussed in the one of the previous videos is that when we talk about the top-up taxes under the BEPS Pillar 2 rules, one really need to compute the globe ETR, the effective tax rate under the globe tax rules at the jurisdiction level. So for example, if an entity has 3 legal entities in a particular jurisdiction in a particular country, then for the purpose of computing the top-up taxes, which may possibly arise in that particular jurisdiction, one need to compute the blended effective tax rate for that particular jurisdiction. So therefore, for computing the global or rather the jurisdictional ETR, one need to look at what is the adjusted taxes which are being paid in that jurisdiction as a percentage of the total globe income in that jurisdiction. Let us say, for simplicity, if 8 rupees is the total covered taxes paid for the 3 legal entities in a particular jurisdiction, and the total income of these 3 entities happen to be 100 rupees, then for the purpose of the top-up taxes, the globe ETR in this case works out to be 8%. Now this 8% one need to compare with the minimum ETR under the BEPS, Pillar 2, which is 15%. So 15% compared to 8% will give you a shortfall of 7%. That means 15% of the minimum agreed rate less the globe ETR, which in my example I worked out to be 8%. So therefore, the shortfall of this 7% is computed on what is called excess profit for that jurisdiction, and then that gives the top-up tax liability for that particular jurisdiction. As I mentioned, this is a much more finer topic, and this requires much more elaboration. So in the description of this video, I will also give a link of my previous video, which will give you a complete insight on how these BEPS Pillar 2 rules work. But from the accounting perspective, after we have determined the top-up tax liability, which in this example works out to be 7%, then in that case, the question is that liability of 7%, in my example 100 rupees, if your total income, that 7 rupees top-up tax liability is collected under the BEPS mechanism under 3 possible rules which talk to each other. So the first priority under the BEPS Pillar 2 rules is that this shortfall of 7 rupees should, as a first priority, collected locally by the jurisdiction where the trigger of the shortfall happens. This is collected through a mechanism called QDMTT, Qualified Domestic Minimum Top-up Tax. Now, if for some reason this is not possible to be collected, then the second priority is the IRR rule will get triggered, income inclusion rule will get triggered, wherein this shortfall would be collected at the ultimate parent entity or by somewhere the highest intermediate parent in the group if for some reason the ultimate parent entity, the jurisdiction, has not so far legislated BEPS Pillar 2. This I will illustrate by way of an example in the next slide as well. And if neither of these two work, which is by way of priority 1 and priority 2, then the third priority is by way of UTPR tax, which is being levied and paid by some other group entities in the group. Let us illustrate this, and then we will go into the financial reporting and considerations arising out of these rules. Now assume that you have a scenario where there is a 100% group which is owned. So the ultimate parent company is in US. This ultimate parent entity has an effective tax rate of 19%, and assume that this ultimate parent entity has 3 direct subsidiaries. 2 of them, which is company A and company B, they are based out of France. Whereas the third direct subsidiary is in Australia, and that entity, let us say, has effective tax rate of 29%. Now, each of these 3 direct subsidiaries, assume they have 1 subsidiary each in Singapore. So company D, E, and F, they are the subsidiary of A, B, and C respectively, and all of these 3 subsidiaries are located in Singapore. Now assume that the global for the 3 entities which we are mentioning here, assume that the global income for these 3 entity happens to be, assume 156, 12, and 12. And therefore, for an effective rate of 8%, 17%, and 14%, the blended jurisdictional ETR for this jurisdiction would be 9%. Now, obviously, if you compare this 9% with the minimum threshold of 15%, there is a shortfall. That shortfall would trigger the top-up tax arising out of operations in Singapore. Now, as you might already be aware, now in the fact pattern, USA is unlikely to legislate Pillar 2 rules. Now, assume that for these 3 countries, out of the 3 mechanisms which we talked about, that QDMTT, then your IIR rules, and the UTPR, assume that in these 3, only and only income inclusion rule has been legislated by these 3 countries. This is just for simplicity, I'm trying to give you a perspective. Now, what happens in this case? Because of the fact that in this case, the top-up tax liability is triggered by Singapore entities, the Pillar 2 taxes will be paid somewhere in between by these 3 entities. Why? Because ultimate parent entity here, IRR is not legislated. And therefore, this entity will not be paying the Pillar 2 rules related taxes. So minimum top-up tax will effectively be paid between these 3 entities. And the split of which entity pays how much, again, is driven by the rules, detailed rules which are there under Pillar 2 rules. Now, suffice to say at this point in time, you will be able to see that entity C, which is in Australia, it has on its own effective ETR of 29%. Still, it can potentially be subjected to Pillar 2 rules. And therefore, even this entity, which is within the group, that's what it says. Note that the Australian intermediary company, this guy, is also impacted by what is happening outside of this entity in the group structure. And therefore, there may be circumstances in which even if your ETR is more than 15%, you may still be impacted by the Pillar 2 rules and may be required to pay taxes. Situations like this will give you an answer. And therefore, it is very, very important that each entity in the group very closely look at the developments which are happening in the entire group. Now, this is the background in terms of how the top-up tax work. Now, how does it impact accounting? Let us first look at what issues, accounting issues, has arisen on account of these BEPS Pillar Two rules. And therefore, it required clarity. In essence, if you look at as jurisdictions, as the countries start preparing and and legislating the Pillar Two rules, a lot of accounting questions start coming in. Some of the key questions which started coming up, and the preparers of the financial statements, they started asking questions like this: whether the top-up tax is within the scope of IAS 12 income taxes. First of all, scoping itself was a question, because the scope of this minimum top-up tax is not on account of the income earned by the entity, but somewhere else in the group is triggering that particular taxes. Second, if yes, assuming that yes, these top-up taxes are within the scope of IAS 2, IAS 12, or for that matter, let's say Ind AS 12 under the Indian situation, then how to account for, whether any deferred tax impacts will be there arising out of these Pillar 2 taxes. And then whether the globe rules create additional temporary differences, creating further deferred tax impact. Whether the entities need to remeasure because of the Pillar 2 rules, whether they need to remeasure their existing temporary differences causing deferred tax, which has already been recognized in the books of accounts. And how entities will determine the tax rate for measuring the deferred tax impact arising out of top-up tax, if any. So these are the questions which were raised by the various stakeholders. And to give answer to all of these questions, the response of IASB internationally was that they amended the IAS 12. This was a narrow escape amendment which was done in May 2023 to IAS 12 income taxes. And that response gives answer to these are the questions which are raised by various stakeholders. Now let us see what is the guidance which have been given in the amended IAS 12. Let's see this, and then we will look at how the accounting impacts and the disclosure impacts are emanating out of those amendments. So in May 2023, as I said, the amendment was done to IAS 12, and this gives answer in 4 different ways. So for example, if you look at from a current tax perspective, paragraph 4A has been inserted in the standard, and that paragraph tells you that and clarifies that the one of the question which was there, whether IAS 12 applies, income taxes applies to these Pillar 2 rules. Paragraph 4A gives clarity to that. It says yes, the amendment clarifies that IAS 12 applies to income taxes which are arising on account of the tax laws which have been enacted to implement Pillar 2 rules. So that clarification has been given by paragraph 4A. Then again, a newly inserted paragraph 88B. This paragraph tells that entity paying Pillar 2 tax to the local tax authority will recognize and disclose the current tax expense. So in the example which we saw, Singapore is triggering the payment, the top-up tax liability. But who is actually paying? It is the entities which are upstream. That means in France and in Australia, in some proportion, they will be paying it. Assume that French entity is responsible for making this payment. So paragraph 88B tells you that entity which is paying Pillar 2 taxes to the local tax authority, in my example which I said, the French entity, they will recognize and disclose the current tax expense in their income statement. That is on the current tax side. What about deferred tax? If you look at the second box, and of course these one more important point is these apart from these two, the amendment also brought in some new targeted disclosures which are required to be given in the notes to the accounts with effect from 31st of December 2023. So based on who, when, what type of taxes or the Pillar 2 legislation have been enacted by the various jurisdictions where the MNC operate, or the MNE operate. So where, when, and what type of the legislation have been enacted and are applicable, that drives the disclosures and the accounting. Now, as I said, that this newly target the new disclosures, they are effective from 31st of December 2023. But no additional disclosure is required in interim periods prior to 31st of December. That means only prospectively from 31st of December that these targeted disclosures are required to be given, not in the prior period. Okay, coming back to the deferred taxes. On the deferred taxes, again, the clarity has been given. Paragraph 4A also clarifies that considering the requirement or considering how the things are unfolding, paragraph 4A says that of IAS 12 says that there is a mandatory and temporary relief from both accounting and disclosure of deferred taxes arising out of the implementation of Pillar 2 rules. What does it mean? It simply means that paragraph 4A tells you that the amended requirement in IAS 12 is that there is a temporary relief from not only accounting for, but both the disclosure and accounting, both related to deferred tax. Current tax you have to record, but when it comes to deferred tax, there is a temporary relief given in the amended IAS 12, wherein disclosures, both the accounting and disclosures related to deferred taxes are not to be there in the financial statements. And this is a mandatory temporary relief. So the entity does not have any choice. It has to mandatorily apply this relief. Also, paragraph 88A, which is also newly inserted, this paragraph requires an entity to disclose that this mandatory temporary relief has actually been applied by the entity. So, to summarize here, the current tax impact, yes, the entity have to record and report, but whereas in terms of deferred taxes, neither the accounting nor the disclosure of deferred tax is required because there is a mandatory temporary relief. Now, you can imagine that this may create a lot of uncertain tax positions because the way it is happening, if in the example which we saw, that you have a US parent or ultimate parent entity which has operations in France, Australia, and Singapore. Now, here we presume that only IIR has been implemented. Now, assume for the sake of argument, let us say here also the Pillar 2 rules have been implemented. Then none of these entities will be impacted because ultimately, if QDMTT, the Qualified Domestic Minimum Top-Up Tax, is not introduced by Singapore, then in that case, these two entities, which is French and the Australian entity, will be insulated from making the payment. Rather, if the ultimate parent entity jurisdiction has implemented the Pillar 2 rules, then the shortfall of 7% in our example, that shortfall would be actually paid by the ultimate parent entity, provided the jurisdiction in which they have also legislated the Pillar 2 rules. And therefore, you can realize that Pillar 2 rules are likely to create new uncertain tax positions. And these need to be dealt with under IFRIC 23, which is a specific literature dealing with uncertain tax positions under IFRS. Corresponding to IFRIC 23, we have Appendix C in the Ind AS 12. So when we apply the same requirement in India, in place of IFRIC 23, we will apply the requirements which is given in Appendix C of Ind AS 12, which is nothing but what is the requirement in IFRIC 23. Now, Coming back, or one more important point on the deferred tax side, this mandatory temporary relief for both accounting and disclosure of the deferred tax arising out of the Pillar 2 rules is applicable immediately with effect from the amendment itself. So the amendment was brought in May 2023. And this amendment is, or this requirement is applicable with immediate effect from May 2023. Unlike that, when it comes to the current taxes, this requirement is applicable from 31st of December. And that too, no prior interim period. It is only prospectively. No additional disclosure required in interim periods prior to 31st of December 2023. Right? That is how it is. And also, these BEP, from an accounting consideration, we need to consider that even these BEP Pillar 2 rules may create additional impairment testing requirement because of the facts which we have laid out here. Now, from an Indian perspective, you will realize that corresponding to the amendment which has already been done in IAS 12, that amendment from an Ind AS perspective has not yet been incorporated in the Ind AS literature. However, there was an exposure draft similar to the requirement of what the amended IAS 12 is, that has been rolled out in July 2023 by ICAI. But so far, it is yet to be notified by MCA. I think as recent as the last week, there are some developments happening on this particular exposure draft. Hopefully, from an Indian perspective, from an Ind AS perspective, this requirement will start from 1st April 2024. That means 24-25 financial year. This requirement, what we saw for current tax and deferred tax, is likely to come up in the Indian context as well. So you should be aware of that piece. Now, this is what the impact which the Pillar 2 rules will have. Now let us see what are the disclosure requirements which are required due to the top-up taxes. Now, as I have said, that the disclosure requirement will depend upon to what extent the Pillar 2 legislation have been already enacted in the various jurisdictions where the M&E group operates, and whether it is already effective or it is just enacted yet to be effective. So if you look at the timeline, assume that you have a situation, Pillar 2 rules have been released, the local legislation has announced that they will adopt Pillar 2 rules, they have enacted or substantively enacted. But this is the timeline up till where you have only the enactment has been done or it has been substantively enacted, but it is not yet effective. Let us say it is effective at a later point in time. Now, the disclosure requirement will vary. Assume that if the legislation which has been enacted or substantively enacted is effective only at this point in time. So during this period of time, the disclosure requirements are different, and during this period of time, the disclosure requirements are different, and go forward, the disclosure requirements are different. And that's what we will see in this particular slide. Let us first look at what happens to this period. When the legislation is effective or substantially effective, is enacted or substantially enacted, but is not yet effective. During this period, what are the disclosures which are required? Let us first see this. So there are three key disclosure requirements. Paragraph 4A and paragraph 88A of the amended IAS 12, the combined reading of that would say, as we have already seen, you need to disclose the application of the temporary accounting relief and the disclosure relief, which is mandatorily to be applied by the entities. And we have seen this is effective from May 2023 amendment itself. That is the day from which date you need to apply. So if you are in a situation where you have applied this relief, then you got to disclose during this period, which is where the amendment are yet to be effective. You have to disclose that you have applied the mandatory relief which have been given for accounting and disclosure of deferred taxes. Secondly, You need to disclose paragraph 88C and 88D. Again, these newly inserted clause, it requires the entity to disclose what is the exposure it has to the Pillar 2 income tax rules on the reporting date, both qualitatively and quantitatively. And I'll just explain what these two type of information relates to. What is quantitative, what is qualitative. Now, it is important to understand this exposure need not be given, in each minute details. Even if there are indicative range of the exposure which is possible, that is also can be given by the entity. Now, when we say qualitative and quantitative, qualitative means answers like this: how the company or the group is affected by the Pillar 2 legislation and Pillar 2 taxes. In which jurisdiction the exposure is arising. The example which we saw, the exposure is arising in Singapore. So where the top-up tax is triggered and where it will need to be paid. So the example which we said, trigger happens in Singapore and in France and Australia. In these two jurisdictions, the payout is expected to happen. Those kind of a qualitative disclosure is required to be given. When it comes to quantitative, you have to give indicative percentage of profits that may potentially be subjected to Pillar 2 income taxes. Also, what is the average ETR which will be applicable to these profits? And how average ETR would have changed if Pillar 2 legislation would have been effective. Because you are giving the disclosure in this period when only the enactment has happened. It is not effective. So this disclosure quantitatively will tell how your average ETR will get impacted, will get changed if this is already effective in this period. That's how you have to give the disclosure in this period. Now, what about this period? When enactment is not yet happened. So in this case, the requirements in the standard is that these two disclosures, 2 and 3, this again is not required, but these two disclosures, even during this period, is highly recommended, though it from a standard perspective, it is not mandatory that during this period you give these disclosures. But from a good governance perspective, from a responsible financial reporter, it is highly recommended that you give disclosures for these 2 points. Now, what happens subsequently after the legislation is effective? So there is one specific disclosure which is required on a go-forward basis. Of course, you will continue to apply the deferred tax related mandatory relief. You will continue to disclose this piece. You will continue to disclose the application of mandatory temporary exception for deferred taxes for each reporting period. Now, apart from this, which is common, after the legislation is effective, what you have to give is the current tax expense related to Pillar 2 rules is reflected in the financial statement, which that needs to be disclosed. Paragraph 88B gives the requirement. That means once it is effective, once the rules are effective, current tax expense will be reflected in the financial statement if you are impacted by that, and that needs to be disclosed separately. I'll give you some illustrative examples of how this has been given in the published accounts which are available. Now, we have seen in the previous case, and I just mentioned, that the group and the entities within the group have to actively look for what's happening in the various jurisdictions. Why so? Because if Pillar 2 rule is effective only for part of the M&E group and substantively enacted in others. So you may have a scenario, you have, let us say, 4 countries. It may happen that in this country or jurisdiction, it is neither enacted nor effective. Whereas for these 2 groups, it is effective. These 2 jurisdictions, the Pillar 2 rules is effective. Whereas it is possible that in the 4th entity in the group, it is only substantively enacted, but not effective. So if you have a scenario like this, where you have multiple entities in the group and each of them are currently impacted differently, then you need to disclose, let me clear this, then you need to disclose all of these 1, 2, 3, and 5, depending upon how the situation in your particular case is. Of course, 4 and 1 are the kind of the same. So basically, all of these is something which you need to disclose depending upon the facts applicable to you. Let us see some of those, the illustrative disclosures from published accounts, how they have been disclosed. So if you see here, I've given the source also. This is coming from the specific annual report of a particular entity, which I've given the source from where it has been taken. Now, if you see this note, this is application of deferred tax exemption, paragraph 4A, right? What we saw. You see here, we have adopted the amendment to IAS 12, which is issued in May 23, which provide temporary mandatory exception from the requirement to recognize and disclose deferred taxes arising from the enactment of Pillar Two rules. This is how you'd apply and disclose the mandatory deferred tax exemptions related to Pillar Two rules. This is a sample in which the entities have been disclosing it. Let's see another one. This one is when substantive enactment of the law has happened. What is the scenario when what is the effective date, and what are the expected exposure which the group may be exposed to? Again, this is taken from the same entity, from the published finances. You can see here, it says that Pillar 2 rules seeks to apply 15% global minimum top-up minimum threshold. But this Pillar 2 rules are substantively enacted by UK on 20th of June 2023 with application from 1st January 2024, which means effective date is 1st January 24. Though enactment or substantive enactment has happened on 20th of June. So this disclosure says that enactment has happened on 20th of June, effective is on 1st of January. Now, if you see the exposure, what does it say? You see here, we have adopted the guidance contained in these Pillar 2 rules amendment, which have been released by the IASB in May, which provides a temporary mandatory exemption relief. We estimate, this is the exposure, we estimate that the exposure to additional taxation in 2024, when it becomes effective on 1st of January under the Pillar 2 rule in this group is, we expect this is immaterial for the group. This estimation is also an expected exposure which you are disclosing. But if it is material or whatever the other quantification is, then you have to give that quantification. That's how the disclosure you have to give. Going further, now when it comes to the expected exposure, another sample illustration is given here. Again, I have given the source from where it has been taken. It's from the DHL's balance sheet. It says, so the group falls within the scope of this Model 2 rules. If you see, beginning with 2024 fiscal year, the group expects an increase in the current tax by an amount in low double-digit millions of euros. This is another way in which expected exposure is given in the financial statements by various entities. In this case, DHL's case. Look at the last disclosure or the sample disclosure. Again, this has been taken from DHL's balance sheet. If you see here, this is on deferred tax exception. It says the group has applied the exception to the recognition and disclosure of information regarding deferred tax assets and liabilities in conjunction with income tax for Pillar 2 as provided in the amendment to IAS 12. So that's how you give the disclosures in the financial statements. Now, by way of the final flow chart, if you summarize all what we have discussed, look at it. So this is what you have to ask questions. Whether the M&E group is subject to Pillar 2 tax. If no, then certainly no disclosure requirements which get triggered. But if yes, the next question is, okay. The second question is whether the new tax is already enacted or substantively enacted in any of the jurisdictions where the M&E group operates as of 31st of December 2023? Answer can be yes or no. If no, disclosure is recommended. We saw that the disclosures 2 and 3 are still recommended, which is given not in IAS 12 but as per paragraph 17C of IAS 1, presentation of financial statement. Using that paragraph, it is recommended that you give those disclosures, though not mandatory under IAS 12. But if answer to question number 2 is that yes, question 1 was whether Pillar 2 is subjected, the M&E is subjected to Pillar 2 tax. Yes, it is. Then whether the new tax is already legislated. Yes. Third question, which type of financial statement is being prepared? Is it consolidated? Is it a standalone or a subgroup? So for example, if it is CFS of the group, then disclosure is required as per paragraph 88A to 88D of IAS 12, which is these are the newly inserted clause in IAS 12. But if the financial statement which you are preparing is the separate financial statement or CFS of a subgroup, then you need to ask this question, okay, whether the company or the subgroup triggers, whether the company or subgroup who is preparing these, is it triggering or need to pay top-up tax? Answer of this, yes or no, will determine what type of disclosures you have to give. If no, then again, no disclosure is required. But if yes, then you need to give again disclosure which have been newly inserted in paragraph 88A to 88D. That's exactly what I wanted to cover for this particular video. I hope you like this video. I have given my social media contacts here. Please feel free to connect with me. And in any other video, most likely next week, I will again connect with you. In the meantime, take care and bye for now. Thank you.